Good morning, everybody, and a warm welcome to the very first Prescient Equity Prescient Equity webinar. So thanks for joining us this morning. I'll do a quick intro on Meyer Kutsia, and then I'll be handing over to the two gentlemen you see on screen. That's Bastian Teichgreeber, who's the Chief Investment Officer of Prescient, and Seeiso Matlanyane, who's the Head of Equities, and the two of them will take you through the presentation. The format will basically be a macro overview insofar as it affects the top-down view on equities. We won't talk any fund-specific story today, but we do want to try and convey the process by which our core equity proposition is managed. So just a brief intro on that. Why core equity? Well, we all know that we've seen lots of research on the low hit rates of active fundamental, call it fundamental stock pickers, because all equity managers are in effect active. And research indicates that around about 80% of equity managers struggle to outperform their benchmarks. And that has really driven the move to popularity in passive investing over the last number of years. Is investors wish to access the equity market beta, but they were paying excessive fees or are paying excessive fees and getting negative alpha. And that really drove the development of the core equity process at Prescient. We noticed two things. Our own research indicated that that hit rate is low. I mean, if one just looks at the general equity sector over the last 5 years, I looked at the numbers quickly this morning. Depending on how you slice and dice it, only about 16% of the surviving funds managed to outperform the capped Swix or all-share benchmark, whichever one they use. So it's very low. But we also noticed that on the money market sector, over the last 5 years, of the surviving funds, 31 out of 32 outperformed the Steffi Call Index, which is a typical benchmark for money market funds. Now, you're going to ask, obviously, what's the relevance of the Steffi Call Index in an equity presentation, and hopefully the two gentlemen that's going to talk you through this will clarify that for you. But lastly, I just want to kind of leave you with a thought about the philosophy behind core equity. And it's really consistent with all our products and offers you the best of both worlds. So the product delivers high beta, similar to passive investing. It delivers low fees or is charged low fees, not as low as your typical passive product, but one needs to look at your returns after fees, your net returns. And the product is designed in such a manner to deliver positive returns after fees, which is obviously not possible in the tracker space. And we can replicate the core equity process on numerous indices. We currently run it on the all-share index locally, the Swix, the cap Swix, and globally we run it on the MSCI World Index, and we're about to launch MSCI Emerging Market product through our Dublin Manco. So we can do it really on all different indices. A last thought on that is that we can, on a segregated basis, run the core equity process on zero fees and only a performance fee basis. And the reason why we say we can do that is because we are convinced that we can deliver alpha and only take fees when you receive alpha as the investor. So keep that in mind. Also, we will be applying for CPD for the session, so please stay in for the full duration. We will circulate the certificates once we get approval from the FBI. And lastly, we will take questions. So if you have any questions, post them and we'll address them at the end. So on that note, I'll pass over to Bastian and Seeiso. Thank you very much.
Thanks, Meyer. And yeah, thanks everybody for joining. We are going to start today by a little bit showing a little bit of a macroeconomic top-down view on equities as a whole, showing our equity view, starting in the States actually, but then moving into South Africa. And then from there, we're going to talk about the dispersion and the challenges which active managers, but also maybe potentially passive managers or enhanced indexation managers in South Africa would face. And Seeiso is going to cover that, but plus also a little bit of an intro to our core equity strategy. the whole purpose is, as Maya said, not to speak about a specific fund, but really about our equity fund range. As I said, we can do the core equity process on any index. And we're going to show you how it works, how the mechanics operate, and in the end, why it's so promising. And we're going to end the presentation actually by also highlighting that now is the time to go for it, because the environment is really particularly interesting and particularly attractive. And I like to say that because we very often hear a lot about it's a good environment for stock pickers, or there's a lot of cross-sectional dispersion, and now it must be really good for picking shares. And then after that, as it was for COVID, obviously, and after that we look, and then it's again this 80-20 ratio of 80% not outperforming. Having said that, we're going to show you numbers why in the core equity process it right now actually measurably is very attractive to use our strategy. So, but enough for the words, let me get right into it. So as I said, we're going to start by looking at our top-down macroeconomic view, our themes which are featuring. I'm not going to bore you again speaking about inflation and the Ukrainian crisis. You know by now our take on it, a quite optimistic take, which will come through in our positive equity view. Having said that, we want to speak a little bit about the Federal Reserve today. I mean, it's literally today, this evening, where we see the outcome of the FOMC. So there's a lot of expectation of interest rate hikes, a lot of uncertainty around financial conditions. So we want to take you through that and what it means for equities, obviously, because this is an equity webinar. Okay, let me start by saying that we are not as worried as the market and not as worried as a lot of our peers around higher interest rates in the United States and then potentially globally. Obviously, that means tighter financial conditions, and obviously that means headwinds to the equity markets globally, but we do think that we are in a position to stomach that. Let me start by showing you a chart where we are basically comparing the US 10-year yield to the US 2-year yield. And this, if I just take the spread between the two of them in the grayish area, you can see at the right-hand side of the chart that the spread is narrowing quite aggressively. So if I plot that gap through time, you will see the gap between the 10-year, 2-year. So this is often famously cited as one of the best recession indicators. And historically, it has worked very well. But we do think that, first of all, we haven't really moved into true inversion on the right-hand side of the chart. So if I do a little bit of zooming and focus on where we are as we speak, you can see we have not moved into inversion. Yes, we've been very close, but we've not moved into inversion. And also that if you look at the shape of the curve today, there's a lot of anticipation of a very front-loaded hiking cycle. So what I mean by that is, we're saying the Fed is going to hike aggressively right now over the next couple of meetings. Probably they do half a percent today, probably again 0.5% next month in June. But then the front-loaded hiking cycle will eventually come to an end, and that's exactly what the market is telling us. Okay, so that's an important message, because it was in 1994, which was basically one of the few examples where the Fed managed to engineer a soft landing for the global economy. And that's exactly how they did it, with a very front-loaded hiking cycle. Okay, so it's just important to highlight that. But there's other reasons why we think one shouldn't be too worried around the hiking cycle. And one of them, actually, interestingly, is inflation. So if you look at the right-hand side of the chart, we're looking at an all-time high over this measurement period, going back all the way until the early 2000s, or basically late 1990s. We're looking at break-even inflations. So we're not looking at this 8% inflation print, because that's a thing of the past. It's measuring 8.5% inflation. It's measuring the price changes over the last 12 months. It's actually quite uninteresting. It's important to see where inflation is going to be going forward. And the best predictor of inflation is the market. And the market is telling us inflation is not going to be out of hand. In fact, the market is expecting inflation rates at roughly 2.8% over the next 10 years. So that's high, but it's not meaning inflation is out of hand. And then there's an inflation risk premium baked into this number as well, which is roughly around 40 bips right now, which means that the truly expected inflation level in the States, despite us sitting at 8.5% right now, is going to be just at probably 2.5%. So why is inflation so important for the equity market? And I don't want to make this fixed income centric. It's an equity webinar. But the reason why I'm highlighting inflation is because it's one of the biggest worries of our market participants right now. And I just want to draw some parallels here also to the early 2000s, showing that we had a very similar level of expected inflation expectations in 2005, in 2004, in 2006. Those were very, very strong equity years. In fact, the strongest equity years just before the great financial crisis. So high inflation itself is not always a train smash for equities. And right now, the market is not telling us inflation is going to get out of hand. So let's not be too panicked about that. Let's also not be too panicked about the Fed, because as I said, the Fed is pointing towards a front-loaded hiking cycle right now. Why are they doing this? For that, we have to look at the global economy, and I'm not going to show too much charts on that. Just going to quickly show the labor market. And here we're showing a 12 months moving average of unemployment claims. So 12-week moving average. So if you look at unemployment claims in the States, they are on a 12 months rolling basis, basically at an all-time low. And that is absolutely crucial to understand, because we are looking at an incredibly strong economy globally. And that incredibly strong economy is enabling the Fed to tighten financial conditions and to hike interest rates. And it's not the fact that inflation is out of hand. Inflation is expected to come in significantly below 3% mark over the next couple of years. Okay, so the pricing of that, and this is basically what we want to very briefly show in this chart. And as you basically see the 10 y-axis, you see the yield, and you can see just the way the yield curve changed through time is we are priced for aggressive hikes at the front end and then not so many hikes at the back end. So trying to say short term, on purpose, the Fed is hiking because they can hike, but they're not hiking because they panic about inflation. And that's all positive. And funny enough, if we speak about core equity, that's where we're going right now. This front end of the curve being steep is one of the key requirements for this strategy to be successful. And this is the US market, but we're going to speak about the South African market and show you exactly that it's looking very, very similar in South Africa. Okay, so that's it from a top-down point of view, but let's now look into equities directly. So I made a quite positive story around US equities, global equities in general, and this scale now still shows you a moderate underweight over US equities. So just to be clear, markets are not just driven by financial conditions and the economic top-down themes, which I've just highlighted. As you can see on the left-hand side, economics, financial conditions, those are not the factors which are worrying. What is worrying us more is a quite poor sentiment, which is driven again by slightly tighter financial conditions and the consumer being weakened. It's also driven by the Ukrainian crisis. Sentiment swings quickly. So this negative print is something which we observe now, which is playing an important role in our model. But it's also not a train smash. It can go into the other direction quickly. Having said that, we obviously also can't ignore valuations. Okay? Valuations in the States are at close to all-time highs, very expensive equity market, and that's what is actually worrying us. Okay. So if I look at the models through time, you can see on this scale here, we have only moved into this moderate underweight a couple of months ago, but now this is where we are. So we are cautious on global equities now, which is different to where we've been over the last 1 or 2 years. Okay, but now to bring it all back home, let's speak about South African equities. And you can see on your screen right now that the story here is a very different one. Okay, so in the South African space, there is one major difference to US equities, and that's valuations. Okay, you can once again see that economics and financial conditions, we're seeing very similar numbers. So these factors are showing very similar prints. On the sentiment side, we're slightly more positive in the States, but again, we might see the South African PMIs or the business indicators to come down as well, especially given that we're heading into new periods of load shedding. But this is now me speculating. What we are observing right now is a quite okayish financial condition and sentiment picture, positive, encouraging valuations. So just to jump into 1 or 2 valuation scores very briefly, I'm going to just highlight the price to earnings ratio, but as you know, we're using more factors in the equity space than just the price to earnings ratio. Just going to speak about where we are really sitting in the PE ratio, and it's like very significantly below our long-term average. And if I do this statistically and really measure where we are actually in the 7th percentile, meaning that we are looking at an exceptionally cheap market, a market with a lot of opportunities. And that's why we like South African equities, despite the fact that we are starting to get worried around the global picture. Okay, so investing in South African equities is attractive right now, but we need to also understand some of the added challenges which we are facing once we do invest in South African equities.
Yeah.
Meyer has already given an intro that it's difficult to stock pick. So how do we go about it?
Yeah, awesome. Thanks, Basti. So this is exactly some of the questions that we seek to answer when thinking about South African equities. And I'm going to just spend a few minutes on some of the work that has been done, particularly trying to look at the general equity sector and the large cap equity sector, the Seeiso sectors, and trying to explain that what drives that performance using the local equity benchmarks. So the key question here and sort of the thesis is there a way to explain the drivers of the categories using just the benchmark indices? And we started by looking at just the last 5 years. We combined the large cap and the general equity sectors, and we charted the cumulative returns. And what you can see there is that there's quite a large amount of dispersion. And our question is to try and understand what's driving this dispersion. And by understanding that, can we try and come up with a strategy to beat that? So that's exactly what we did. To do so, leveraging off our sort of systematic expertise and our methodical ways of looking at investing, what we did is we started our analysis by creating 1,000 random portfolios at any given point. And then we measured for each of these portfolios their relative return relative to the category averages. So that gave us a long list of alphas, and then we observed this daily, and then using those alphas we calculate the tracking errors relative, so the rolling 2-year tracking errors relative to the sectors. And what this allows us to do is to be able to, just using the broad market indices, basically come up with a portfolio that has the lowest tracking error relative to the indices, so that moves as closely as possible to the general categories. So how that's done, we said this is a snapshot of any particular day. These are the random portfolios that have been calculated, and these are the tracking errors, the rolling 2-year tracking error relative to the categories. So we just take the bottom 100 tracking error portfolios and just combine their weights to come up with one portfolio that is most representative for the category. And then we do that through time, and we can chart how this tracking portfolio, so this portfolio that closely mimics the category, how that tracking error looks through time. And as you can see, it ranges between 65 basis points and 46 basis points. So it's very close and a good explainer of what exactly is driving the sector performances. And observing this through time, we can come up with a current allocation and a way to look at the sectors in the South African equity market just based off the indices and what basically the portfolios or the other managers that are in the sectors, what exposures they have to the local indices. So what is actually driving their performance? And this is without looking at any fact sheets or holdings. And we can robustly say that it's mostly at current, most of the sector has been driven by the Aussie performance, the cap Swiss performance, the Swiss performance, and the capped Aussie. And what's interesting to note here is that over 80% of the sector performances has been being driven by sort of your broad market indices. So this is the universe of indices that we're using to explain, and that sort of speaks to the diversified nature of the sector holdings. We can do the exact same thing and just have a look at it through time. So explaining exactly what has driven the sector performances through time, and you can see it's been mostly the Aussie, and we had a big structural change here. This is when we saw certain shares like Naspers becoming too big in the indices, and therefore introducing a lot of idiosyncratic risks, and the sector, the peers move towards more of a capped sort of allocation, and then we've seen it reverse back as Naspers has been selling off over the last year or so. But we can have a look at how, on average, what has been driving the sector performances. And this is a robust method with literally no emotion and true to our sort of way of looking at investing. But then, okay, great. What comes from this? So our findings are pretty much as expected. Is that using just the local indices, just the broad indices, and tracking the indices in a sort of a clever way, you can actually come up with a way to beat the peer average at about 1% per annum. So that's what the numbers come out to, and there are two reasons for that. The reason that this portfolio beats the peer average by 1% per annum is one, because of fees. So this tracking portfolio assumes that we're simply investing in the indices, whereas obviously the portfolios in the category are after fee returns. So the big revelation then from this is that if you can come up with a simple tracking portfolio that is constructed in a clever way, and importantly, you can run that portfolio at a TIC that's less than this 1% per annum, then you're going to already beat the peer average. And this sort of brings us neatly to our core equity strategy, which leverages off of this sort of thinking. So if I just move quickly to our process and how we construct our core equity strategy, and sort of what our thinking is in terms of the core equity offering. So what the Prescient core equity strategy is essentially a mix of both passive and active investing. What does that mean? It means that we're looking to offer the best of the positives from passive investing, which are low tracking errors, which leads to low turnover and low costs. As we saw from the previous study, if you simply can run a portfolio with a TIC that is cleverly constructed, you can beat the peer benchmark just on the low costs and the low fees. But we know that passive investing on its own has its own issues, right? So a passive portfolio, by definition, is guaranteed to underperform. So it underperforms its benchmark. So even though you can construct a portfolio that is made up of different benchmarks that beats the peer average, a passive portfolio relative to a specific local equity index is guaranteed to underperform left to its own devices, simply because of the long laundry list of fees that are associated with running a portfolio. So management fees, admin fees, all dig into that performance, which means there's guaranteed underperformance relative to that benchmark. So there's a need to have an enhancer. You have to enhance the performance of a pure passive or tracker portfolio. Hence, in our strategy, in the core equity strategy, we incorporate elements of active investing, which enhances the returns of the pure passive tracking. But we do this in a way where we allocate our capital where we see the most consistency and the most reliability of performance. And I'll go into what that means just now and how exactly we do that. But you put all of this together and you come up with enhanced indexation. So indexation, but that actually is designed to generate performance that is greater than the benchmark that is actually tracking, but this is done at a very low tracking error. How are we able to do this? We use a concept called portable alpha, which is not a new concept, but requires a very specific set of components to be done correctly. So doing the easy things right. And the way portable alpha works is simplistic, is very simplistic, in the sense that instead of replicating a index using the physical holdings, we replicate the index using a unfunded method, and this allows us to allocate that cash efficiently, the capital efficiently, to an asset class that provides the return that we require. So what does that mean? Instead of holding the actual index by holding the shares and getting that market return, what we do is we buy a instrument such as a total return swap or a future on that beta, that equity return that we want, and then allocate that cash efficiently towards an asset class that generates the consistency in performance. And Maya mentioned at the beginning, there's numerous studies that show this. In the equity space, only 2 in 10 managers manage to generate equity alpha by stock picking, but it's the exact opposite when we look at the cash and income space. It's much easier, it's much more predictable and reliable to beat cash than it is to beat an equity index by stock picking. And hence, we put the capital to work in the cash space where we have that reliability of performance. And to sort of illustrate this more practically, we simply buy a future or a swap on the index. So we pay a floating rate, and we receive the total return. So we have that the pure tracking beta from the index, and then we put the cash in a 1-year sort of senior unsecured banknote. And that 1-year senior unsecured banknote will give us a return that is higher than the cash rate because of 2 premium. What we're exploiting there is simply term premium and then bank credit risk. These are risk factors that we're very comfortable taking on, and that have been proven to deliver that alpha, and that allows us to take that alpha then and just put it on top of equity beta. So it is equity returns with fixed income alpha. So the reliability of fixed income alpha. And as sort of primed earlier, the current environment is such that it is so attractive to borrow at 3 months and invest in a 12-month instrument. The front end of the curve is so steep that you get such a big pickup, and it's so attractive to run this sort of strategy than it's probably ever been, and hence we are able to generate that consistent outperformance.
So very easy process actually to literally just buy the beta of the equity market, which is straightforward and you can do that basically without risk, and then you move towards generating your alpha where it actually works. So I mean, Maya mentioned in the intro, 31 out of 32 money market funds beat cash. So means that this portion, this alpha, which you can see at the bottom left of the screen, is actually achieved by 31 out of 32 funds in the fixed income space. And at Prescient, obviously, we are good in the fixed income space. We are good in the asset allocation and derivative space. So we bring it all together in our core equity strategy. And it's pretty easy. I mean, that is the reality. You get the equity beta, you don't get the equity alpha, but you don't want the fixed income beta, you want the fixed income alpha. You combine that, and that's exactly what we do in our core equity process, a process which we are following since years, many years. We've ever since done it in our balance fund very successfully, as you know. And now in this strategy, we are just showcasing it, how to do it in separation. Okay, so we spoke a lot about why, how it is so very attractive to do this exactly now. So that obviously one always must be careful, but we like to put some numbers behind our claim. So what we're showing here on this screen in the dark blue line is a 1-year NCD. So that's a 1-year fixed income instrument, senior unsecured, by one of the big 4 banks. And then we're comparing it against 3 months JIBOR. So that's basically your floating the 3 months interest rate, which we are funding, which we are used to fund or borrow or get the cash for the futures. So the shaded area at the bottom, this turquoise greenish area, is basically the gap between the two. And obviously on the right-hand side, on the right-hand scale, you see the gap. And the bigger the gap, the better, because what we are earning in this process is literally A minus B. So you can see that with that chart reaching an all-time high on the right-hand side of the scale, a gap of almost 2%, or actually as we speak, more than 2%. You don't have to take credit risk other than the big 4 bank credit risk. You don't have to take term risk other than, like, call it a 1-year bond. So if Standard Bank or ABSA doesn't default in the next 12 months, this process will make alpha and quite a bit extra process. And we also want to illustrate the curve and the shape of the curves once again for the South African space. In this chart, we're showing in the dark brown basically the curve 2 years ago, and then in the as we speak. In the red dot at the left hand side is basically the repo rate. So you can see, I mean, on the x-axis this is a short scale. So if I go to May, basically May 2023, you can see that interest rates are like roughly 3% higher. I mean, that's just, if you assume there's four hikes in a percent because they hike with 25 bips, I mean, that's 12 hikes. So how aggressive can the SARB hike to go past that quickly? So interest rates going up is really not worrying us here. The term premium is so massive. You get so much compensation that it is actually, going forward in this process, quite easy to make money. Not that it hasn't worked in the past, it's just the environment is even more attractive than it has been. Just also want to illustrate it here. We're just using an example of some of the instruments which we use. So you can see on the left-hand side, we're showing 3 months JIBOR, which is basically, again, the rate which we are funding. So currently, as we speak, sits at 4.4%. And then we're showing some of the instruments which we would invest into when we go with our portable alpha process. All of these are senior process. You can see the T-bill on the right, and that's even government bond exposure. So very, very conservative instruments, not a lot of credit risk. Very short term. So the NCD we're looking at here is like a 1-year NCD. The T-bill is a 1-year T-bill. The floating rate is a 3 month floating rate note. So 1-year term, 3 months floating. So super conservative, and you can see the gap is just so massive. So if I again bring up a 1-year NCD and compare it against 3 months JIBOR, you get a 2% alpha. So you don't have to be a rocket scientist right now to generate alpha within this process. If I would be worried about interest rates going up more than what the market is priced for, which is not what we are, but if that would be the case, I can still choose a floating rate note or a CLN. I still get more than 1% alpha. So it's just very, very attractive, the environment we are operating in, and that's what we want to illustrate. Yeah. So we kind of at the end of our presentation already was just basically highlighting how we do portable alpha. We don't want to talk about it too much in detail because it becomes quite technical quickly. We just wanted to illustrate some of the advantages of this process. We wanted to highlight the reliability of this process, the very limited risk taking, definitely less risk taking than any stock picking approach. And we wanted to highlight that the environment right now is just very, very attractive.
Yeah. And I think the other thing just to highlight there is that given the way that this process runs, it runs at a significantly lower TIC than any other traditional equity portfolio, because we're simply buying synthetic forms of the benchmark, and the rest of the cash is placed in these very safe money market assets. So we can offer this at attractively, significantly attractive TICs.
Thanks.
Yeah.
Yeah, if there's questions, please. I'm pretty sure there are some. Please go ahead and ask.
Thanks, guys. Yeah, something I maybe just want to re-emphasize before we get to the questions is the whole issue around risk. So everybody is happy with the risk in a stock pick portfolio, and it can be significant. I mean, apart from just getting your picks wrong, you can end up with liquidity risk or various other idiosyncratic risks. In our process, we really consist of two components. You mentioned derivatives, and just remember that the derivative market is vastly more liquid than the physical market. So liquidity becomes much less of an issue. There is no gearing and short selling in this product, obviously, in the derivative side. And those are typically characteristics used by hedge funds to enhance returns or lose more money. So our derivatives are essentially plain vanilla to get market exposure. Then you look at the cash component. And in a unit trust, that cash component has to abide by the regulations as per Chapter 2 of Board Notice 90, which is the same as for money market funds. And remember, money market funds are priced at 100 cents. So a money market fund by regulation cannot take risk that will break the buck. In other words, result in the price dropping below 100. So the enhancements in the cash side is really very low risk, but there are opportunities, as we see now in this slide on the screen, that one can generate that alpha. The second point I just quickly want to make before we get to questions is we've spoken about a number of indices that we use in this product, and then Seeiso showed us how we effectively decompose the general equity sector into a blend of all these indices. Now we are in a process of converting the Prescient Equity Fund to do exactly that. So if you are an asset locator and you have a view to implement on a specific sector, you can either use the core equity product that is based on that benchmark, or if you want a general equity solution, it will be represented in our equity fund, which is soon to be launched. Okay, if we get to a few questions, I'll just start from the top and read them as they came in. What are earnings like in South Africa relative to the history? Earnings seem really high, which could put pressure on valuations if they don't continue to grow from here. Have high earnings had an impact on equity market returns in the past? So what is your view on that?
Yeah, so if we go back to that PE, just want to show you that. Yeah, so just want to look at our valuations. So we've got our relative earnings yield there, and what we can see. Yeah, so there we go. We've got it on the screen there. So you can see that earnings are still below, sort of like the equity index earnings are higher than the forward EPS. So the question of whether these have had an impact on the performance historically.
I guess it's an interesting statement to say that the earnings, I mean, we have earnings which are basically at all-time highs, so it's very attractive, and we can see that the rally, especially post-COVID, has more than justified, the rally in earnings has more than justified the index performance. That's why we are arriving at a low PE ratio, because forward earnings have outgrown the index aggressively. But I mean, we're not just looking at the forward PE ratio, but even if we look at the historical PE ratio, you can see, and this is what we showed earlier in the webinar, we are looking at historically super low a trading PE, which is sitting at very, very low levels. So whether we look at the trading PE or we look at the forward PE, forward PE, we're looking at very, very attractive levels. And we could even take it one step further and look into the price to book, price to sales. On each and every valuation metric, we're looking attractive. So yes, one can poke holes in every expected earnings story, and we are especially critical, skeptical when it comes to forward earnings prediction. As we know, we don't operate with fundamental analysts extrapolating earnings, exactly what we don't do. But if you look at the ratios, any single price ratio will point you towards an attractive valuation environment.
How will your strategy change in a decreasing interest rate environment?
Okay. Yeah. So what we are really extracting here is the relative spread between where we're funding and the yield that we're getting. And as I mentioned, there's two premia that we're really extracting there, and that is credit and term. So regardless of whether the interest rate environment is hiking one or a cutting one, as long as there is a term and a credit pickup to be harvested, we will basically generate the alpha. We will always have that positive carry, being that we will always be borrowing at a lower rate than what we are able to get. The only key, the key sort of question is how the strategy changes when you have things like spread duration, where spreads are actually changing, and how our portfolio changes in response to the changes in the spreads. So the actual level of interest rates, whether the interest rates are going up or down, is not much of an impact to our strategy. What matters is how that spread, the change in the spread. Yeah.
Okay, but so leading to that is then what would you do if that spread turns negative? In other words, if alpha isn't available?
Yeah, so we have not seen a situation where the spread turns negative. We have seen instances where spreads compress quite significantly. A good example of that would be during the COVID crisis, where there were razor thin margins between where we're funding and the yield that we're getting. But we monitor this on a daily basis, and the strategy, because the strategy hinges on being able to extract that in a situation where that were ever to turn negative, highly unlikely, then what we would have to do then is simply revert back to a pure sort of tracking portfolio, where we simply buy the physical in a fully funded way. And as we showed in that research, is even if you are holding the physical in a pure tracker, if you do that cleverly, you can still generate performance relative to the peer average.
Yeah,
So,
I mean that really means that our worst case is reverting back to a tracker fund.
correct.
Yeah. All right. Sorry, Bastian, were you saying something?
No.
Okay, I thought.
Like historically, it's basically impossible that there's neither a credit nor a term premium. So in an environment where you have positive expectations on the global economy, there will be a positive term premium because you expect rates to go up. In that environment, you probably have thin credit spreads. If you expect in the opposite, like an inverted yield curve, because you're expecting a recession, that's where you maybe have an issue to get out a term premium, but that's normally when credit spreads are tight. So exactly as Seeiso said, we can always revert back to a full replication. I don't foresee it happen at any point in time, to be honest.
All right. Listen, in just a couple of questions that I just need to clarify. It relates around to the peer group and the blend of indices, and I just want to clarify or repeat what I said. Is that we have done the work to design a product that will replicate the peers more closely. And obviously that won't be a static allocation. It will change dynamically over time as the peer group's components changed. And that product will be housed, or that proposition will be housed in the Prescient Equity Fund. As the fund currently stands, it's not managed in that way. It will be managed in that way once we've been through the corporate action. But looking at the Prescient Equity Fund fact sheet, I mean the performance history doesn't look as rosy as the picture it was sketched during this presentation. Maybe you can just comment on that and comment on development in the process over the last year or so, and why the historic performance is in this case not an indication of what one can expect going forward.
Okay, yeah, I can take that. So the Prescient Equity Fund as it currently stands, so this is not the Prescient Core Equity Fund, just the Prescient Equity Fund, has been through a number of sort of iterations, and it wasn't run using the portable alpha strategy historically. So it has been a sort of smart beta portfolio, which had numerous factors, value, momentum, growth, etc. And it's not a representation of the consistency of the performance that we hope to get from, or that we are getting from, a portable alpha strategy. So it was a physically replicated portfolio run using a smart beta approach. And what we're showing here is the core equity strategy, which is a fixed income alpha and equity beta.